Good afternoon and welcome to the S&U PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Anthony Coombs, Chairman. Good afternoon to you, sir.
Good afternoon and good afternoon everybody, and many thanks to IMC for making it much easier and more convenient for our retail investors to talk to us. We value these opportunities a great deal. Can I, before I begin, one or two comments on our results, introduce the team here? I think you can see on the screen. On my left, immediately on my left, is Carl Werner, who's the new Chief Executive of Advantage Finance. We're delighted to have him on the team. He's made a flying start to his tenure as Chief Executive. On his left is Graham Coombs, who's the Deputy Chairman and my brother. On my right is Ed Ahrens, who is the very successful Chief Executive of Aspen Finance, which is our bridging finance, which is doing very well indeed. And on his right is Chris Redford, who is our finance director and in charge of making sure that the ship of state, if you like, in terms of S&U, is travelling smoothly, steadily, and upright. So with that, I'd just like to say one or two things to investors about our results, which you will see in front of you on page 4. Do you have that on page 4? Yeah. By the way, on page 3, we've included this year a number of testimonials from our very happy and satisfied customers, because don't forget, customers, together with the staff that serve them, are what makes a business successful over the long term rather than just over the short term. And we very much value what they do. Right, without further ado, moving to the highlights of this year, you'll see that there has been a hiatus in the steady, sustainable growth of profitability in the group. And that is despite the fact that the group continues to trade, I believe, very well in both of its motor finance and property bridging finance divisions, Advantage and Aspen. And despite the fact that the markets in which they serve are actually both improving and robust at the moment. But the reason why there has been a hiatus in profits growth is twofold. First of all, is that the inflationary climate in this country was both more deep-seated and led to higher levels of longer-term interest rates than was originally anticipated. I'm not going to make any political comments on that, but you can draw your own conclusions as to my view of the competence of the current government. The second reason was the introduction in the middle of July of the new consumer duty, which came with it a whole series of investigations from the Financial Conduct Authority into the motor finance industry. This wasn't just Advantage in the motor finance industry. We believe that the vast majority of our competitors have been subject to very similar investigation by the FCA, and that focused on forbearance, it focused on affordability, it focused on vulnerable customers. It focused basically on that area of our business of which we've been most proud, which is the relations that we've had with our customers over what this year will be our 25th anniversary. So we've got a lot of experience in this business in dealing with the customers who we value so much. However, because of the investigation, the FCA did set certain preconditions on how we interact and collect from our customers, and these have had an effect in the quality of our collections in the second half of the year. Hence the prudent provisions that we've made against that, and also hence higher costs of compliance, which although necessary, we don't anticipate will be there permanently, although part of them obviously will be part of our new compliance network. So that's the reason why there has been this hiatus in profits. We don't anticipate that being in any way permanent, and that we will resume our habitual sustainable growth path in profitability next year. And that's why we've maintained our dividends, so far as it is sensible to do so, at about 120p per share, despite a drop, as I say, temporary, in the earnings per share. And we anticipate that we'll bring our dividends back to normal over the next couple of years. So without that, that's the highlights. And I'd like to take the first question, please. Oh, so, yes, no, sorry, I do apologise. Well, let's do the first question. Yeah, let's do the first question.
So the first question we have is from Pat, who has asked, do you expect to undertake a redress exercise, and what is your view of the overall costs?
I'm happy to pick that one up.
Yeah.
It's probably a little early as we go through this process in a similar lockstep to many other lenders to answer that question too much in the affirmative at this early stage. In the wider part of that question, which is around overall cost, whilst the cost of operating in this modern market never seems to reduce too much, there is, I think, an awful lot of opportunities to improve efficiencies across the firm going forward. So a balanced answer to that question.
Yeah.
And we have another question from Pat, which is, will the BIFID review and or CD increase to lead to increased headcount and overhead costs?
By CD, you mean consumer duty, just for people, and BIFID review is business borrowers in financial difficulty. That's the acronym given to it by the FCA. So over to you, Carl.
Yes, we're not envisaging significant further increase. Consumer duty is approaching in the months ahead its first anniversary. Obviously, all firms would have invested in preparation and embedding that, but it's an evolving piece of legislation that with ever-improving MI and review enables us to look at products and services differently, and hopefully pipes in some innovation going forwards. There may be some temporary increases as we move through the regulatory engagement and take up other opportunities before returning more to the norm. But nothing out of the ordinary would be the view as of today.
I appear to have been a bit eager to get to the interactive part of the presentation, and in one sense, I think that is going to be welcomed by participants and investors. But I do think it's important that we present to you the group financials and go through quite speedily the presentation that we prepared beforehand, which actually I understand that investors have in front of them on the screen. So without further ado, could I ask Chris Redford, our Finance Director, to address the page 5, the group financials.
Thanks, Anthony, and good afternoon, everybody. The income statement, which some of you might have picked up from our announcement this morning, but I'll just give you some highlights. The revenue was up 12%. That's slightly better than the average book debt increase during the year. Why is it slightly better? Because we've nudged interest rates in a good direction. Not quite as much as other interest rates, but there has been some progress there. Impairment, Anthony touched on in the highlights, 74% up on the previous year. Aspen is a nearly nil impairment model, so this is mostly about our motor finance business. Why has it gone up? Well, we talked in the highlights about an increase in arrears and lower customer repayments in the second half of the year. As we navigate through the cost of living crisis and also the regulatory that Carl will kindly talk about later, we expect that to come back a little and repayments to improve. If repayments improve, then the impairment figure should be more normalised. It is up against quite a low comparative for last year, so that was a lower than normal impairment number, where this year's number is slightly higher than normal. On the admin expenses, you can see a 22% increase on this slide. So what's behind that? What's the story? We have had extra regulatory costs, about £1 million in skilled person and shoesmith costs arising from the current discussions with the regulator and the borrowers in financial difficulty and forbearance that we're still engaged with now. That's quite a conservative figure, that £1 million, because it's kind of estimating the whole cost of the exercise, some of which is still ahead of us. If we get further into the exercise during 24-25, there may be some more costs, but we think we should have accrued the bulk of it behind that admin expenses there. The other thing to say about the admin expenses this year, because it is quite a big increase, is that some of you who follow us more closely may remember we gave our staff a couple of pay rises last year when inflation was doing something weird and wonderful in terms of accelerating away, and both as a reward and to retain our staff and help them with their own cost of living, we did give them a bigger pay rise. So that part of the admin expenses is probably more baked in. Finance costs, Anthony mentioned, clearly they've doubled, 7.5, 15 million. Remember, we're quite a low geared finance company, so yes, that's painful for us in the P&L this year, but it doesn't kill us. We may benefit a bit if interest rates do start to come down. In terms of our own businesses, it's easier to reprice some of that finance cost into our shorter term book at Aspen, but obviously it's quite a lot more difficult with the HP product advantage, which is over 4 or 5 years, and we've also got to bear in mind competition, but that's the story behind that line. And bottom line is we made 33.6 million profit before tax as a group versus 41.4 last year. The split is at the bottom. We've talked a bit about the relevant headwinds at Advantage that decreased their profit before tax this year. Aspen, I'm happy to say, continued their path of increasing profits, 4.4 million there up to 4.8. We have proposed a final dividend of 50p. That's down a bit on last year's 60p. As Anthony mentioned, we are slightly less covered on the dividend this year, but we think that's the right approach and reflects our confidence in the future. Could we move to the balance sheet, please? The balance sheet, as ever for our business, is quite a simple balance sheet. It comprises in the main receivables, borrowings and equity. So what's happened on the 2 receivables book? Well, I showed you there, motor finance up 8%, property bridging, the smaller of our 2 businesses, up 15%, and borrowings up 14%, have gone from 195 up to 223. That's within total committed facilities of 280, so still a bit of headroom there. And in terms of equity, that's still, even in a more difficult profit year, that's still moved in the right direction, 4% up on the figure last year. If we can move to the slide on cash flow. This is the where has all the money gone slide. So it's split into 3 sections. You've got the group movements in cash flow on the left-hand side, and what we hope are more useful presentations of the cash flow in each business in the middle for our main business Advantage and on the right-hand side for Aspen, so that you don't just see the movement in book debt on this cash flow. What we're showing you is how that is comprised by cash flow gone a particular way by reasons of what's happened on advances or reasons of repayments, which we break down into the different segments. So hopefully that's useful to investors and attendees today. In terms of picking out some highlights, advances were down from 186 million to 175 million, but that was actually the second highest ever. So still a good story on advantage, and we're still investing in the business that way. In terms of the corporation tax number, you'll see on advantage, even though we've made less profit, we've paid a bit more corporation tax. In the background, you may be aware that government put the rate up from 19% to 25%. This year we've paid a blended rate of about 24%, being 2 months at 19% and 10 months at 25%. So we will get the full impact, unfortunately, of the 25% next year, and that affects this cash flow figure, but it also affects things like EPS. On the right-hand side in Aspen, one thing to comment on, year on year, there was a big increase in both repayments and repayments beyond term. We think that's a good indicator in that it proves that people are getting exits, and it helps the Aspen Bridging model. So we're pretty pleased with those numbers. On the left-hand side, I split down why has the overall borrowings, including overdraft, moved from 192 to 224. Well, there's an 18 million outflow on motor finance, but please remember they pay most of the dividend. So you see in the middle chart that Advantage pay £15 million of the dividend, which is passed on to investors by SU. And then on property bridging, we've invested 14 million in that business, and we think that's sensible, steady and sustainable growth for that bridging business. So hopefully that picks out highlights in the cash flow. On treasury and funding, followers of the business may recall that in May 23, we sourced an extra £70 million in committed funding. So our total facility is now at 280 million, which I mentioned when we looked at the balance sheet. There's some maturities there. Our gearing has gone up 10% in the year, but it's still quite low for a finance company. So although we have suffered a bit of pain with interest costs this year, we're not overly exposed to interest because more than half of the book debt is actually financed elsewhere. Thank you for listening to the summary of group financials, and I'll now hand over to Carl Werner, who is the CEO of Advantage Finance. Over to you, Carl.
Thank you, Chris. I'll speed through, mindful of lots of questions coming in. First of all, I just want to extend my thanks to everyone, the chairman and everyone at SNU and Advantage for a very, very warm welcome. I was in the role from the 1st of February, although joined the business to observe and learn till just before Christmas. I'm delighted to be part of a business that has such a clear and rich heritage, huge experience and expertise. I find it a business with a really strong, empowering and safe culture, and supportive, with a true commitment to customers, and where customers have real visibility across everywhere within the business. Turning our attention briefly to the results, this first slide is around new business momentum. The strong volumes and growth in average advance demonstrates that we continue, after a generation of building it, the support of the market, many thousands of customers and our intermediaries. That enables us, as we look to improve our written credit quality in the future, to leverage that commercial momentum, which is so overpowering, to sharpen our capabilities with a future view to improve returns. And I'll touch on it a little bit later in a couple of areas, but we've talked about already the regulatory engagement across all of the market, as well as here at Advantage, as that came to pass really from H2 onwards. I can certainly say that we're embracing that engagement for the greater good, but it does come at a cost. Turning to the next slide, which looks at our collections results from H2. A few things are happening here in the top two, which is around the cash collected and the adherence to monthly payments. We're seeing widely publicised and under challenging macros increasingly biting. The expansion of our risk appetite earlier in the year and beyond, much was learned as far as our credit risk capabilities are concerned, but we look to amend those a little going forwards, as I say, right, higher quality business. And an abundance of caution whilst we operate and which we do so, but also under some minor, and as I say, already easing minor restrictions. The bottom two graphs illustrate both our credit risk expertise and cautionary approach to lending with lower loan to values, hence why you see actual case number of bad debts and BTs well within budget. Turning our attention to the next slide, which touches further upon regulatory engagement in our sector. You've heard already that that's an engagement that's across probably more than 50% of the market. Even more so for those of us striving to support the underserved. The most commonly quoted headlines are around discretionary commissions, which Advantage is not exposed to. But we maintain a watching brief. If we look to the summary of that engagement on the left of the slide, as I say, a watching brief for the discretionary commissions, but unexpected to represent too much by way of cost or effort within AFL. The BIFID, the market study Anthony referenced earlier, is well progressed. The industry expects that to draw to a close towards the end of the calendar year. We're making good progress, but wouldn't commit to a date for that to be concluded at this early stage. Consumer duty, as I mentioned before, Graham, is evolving, and we're well progressed and engaged with everything else to do with the access to credit and financial resilience. One great thing to highlight is actually what happens on the front end when it comes to customers who have cause to complain. And as you'll see from that table across the industry, Advantage have the lowest uphold rate, which demonstrates the efforts we put in on the front end. To the next slide, a very brief summary of our efforts on consumer duty. A very engaged and highly invested process leading up to the rollout as it continues as we get towards the first anniversary. Good examples there in the pack for your information as to some of the efforts made thus far, not to mention direct quotes from our customers as to the value that we add to them and to society as a whole. And on to the last slide, the messages I'd highlight here would be we utilise challenges when it's time to wrestle. We do so by way to build better muscle for the future. We're refining and building upon very well established and strong foundations. A year of consolidation, yes, but one in which it bodes well for our future opportunities once we're through that more internally focused and consolidation phase. I'll pass back to Chris to unpack for you in a little bit more detail the financials for AFL specifically.
Thank you very much, Carl. We generally show you some slides on the metrics every half year and every year, so I'm just going to very briefly whip through those, pick out a couple of highlights. So the first slide here is the quality of the loan book and the new deals that we're putting on each year. So we've got the last 5 years there, so you can see the trends in terms of number of loans, average advance continuing to go up, cost of sales, £961 in the latest year for information. About £700 of that is introduced commission. So it's a variable cost that goes straight to the broker. Some of the other costs are variable as well. So this line also contains things like consumer credit referencing costs, our data costs, and also some of the frontline staff costs in terms of underwriters, salespeople, etc. So hopefully that gives you a guide to that particular line. You will note that the interest rate went up to 16.9, so that was a nudge in the right direction this year in terms of trying to reprice what is a fairly long-term book in terms of its portfolio profile, and that interest rate was the direction against an average customer score, which is an internal measure of quality that stayed reasonably stable. If we could just move to the next slide, please. This is a very interesting slide in my view. So the left-hand scale and the blue line show the percent of customers that paid their first payment on time. So can you see over the years from 2003 through to 2024, that has paid somewhere between 90% and a peak 99% of customers paying their first payment on time. So the trends are quite interesting. In the early days, we had manual underwriting. So the first payments were not as good, so 90 to 95%. But as we gradually automated and got more skilled at the credit risk side of things, it went up. 2013-14, we were attracting post-credit crunch, a lot of very high quality customers that paid not just their first payment on time, but continued to pay very well. It then got a bit more competitive with the rise of internet brokers and other lenders coming into the market. So it has settled over the last few years. Can people see the blue line at about 97% of customers paying their first payment on time? You will note towards the right of the chart, we've got a couple of blips. So the first blip was just at the start of the pandemic, when people panicked a bit and didn't pay their first payment on time. We've also had a blip at Christmas this year, which happily for us has recovered a bit in January, but we'll continue to monitor that as we go forward. The chart gets more interesting when you look at how it correlates with the end outcome after 5 years, which is the red line. And there is quite a good correlation there between the way customers make their first payments and the end outcome in terms of the percent of bad debt after 5 years, which is the inverse scale on the right-hand side. So that's varied between about 10% and about 30% over the years. We've only got firm figures for that up to 5 years ago, inherently by definition, up to 2019. It still seems to be correlating up to that point, and the dotted red line is a forecast, which is less certain as it gets to the right of the chart, but we still think there'll be a good degree of correlation between first payments and early repayments and the way these accounts end up after 5 years. We could move on, please. This is a simple payback chart that we show you every year. So the blue lines are the investments we make or have made each year from January 15 up to Jan 24 in not just advances, but also the initial cost of sales for new loans put on in that year. And you can see what I referred to earlier, that Jan 24 was the second biggest after Jan 23 in terms of our overall investment. The green lines show the more exciting things for the finance directors. It's getting the money in. We obviously have mainly finished collecting on Jan 15 through to Jan 19, so they're mainly finished. But the others, as we move up through Jan 20 up to Jan 24, they're more forecasts, and we'll see whether those end outcome estimates manifest themselves or not. If we can move to the next chart, please. The final metric chart that we're showing you is the receivable position. So this is an analysis of the book at the end of January 2024 versus a similar analysis at the end of January 2023. So of the 66,702 accounts on our live book in Jan 24, 47,622 were up to date, and you've got that as a percent of live receivables as well. Legal and debt recovery is just follow-up debt, where basically we've had the car back, but we may still be discussing with the customer making additional payments. The value of that book you can see is only £5 million versus the live book, which is the bulk of our asset in the balance sheet at £327 million. I'll now hand over to the CEO of Aspen Bridging, Ed Ahrens, and he'll take you through what's been happening in that business and where the focus is this year for the future.
Thank you, Chris, and good afternoon to all. It's been a good result for Aspen this year, particularly in the second half of the year with strong and balanced growth. Beginning of the year was a little bit stickier, but overall we got to the end of the year where we wanted to get to with record number of loans out in the year. And also a record number of repayments, which, as Chris said earlier, is a good thing for the business. It just shows that our borrowers can actually refinance their loans and are also selling properties. We've maintained the quality with only 15 of the loans beyond term out of the 163 at the year end. And we remain very positive about the bridging market for us and for our prospects for this year. To just looking at the trends in the business over the years, You can see we've made a lot of progress on the cost of sales as we've become more known in the market and with a broader base of brokers. So we're in control of the cost of sales. We're in control of the LTVs that we're at there, and this are based on conservative valuations. We made some progress also on the blended yields, where we've been moving up the interest rates, not quite in line with the Bank of England movements, but we've passed on as much as we can sensibly and reasonably and remain competitive in the market. But otherwise, the terms remain unchanged, and we expect the outcomes to be positive all round. So just moving on to the next one, thinking about 24-25, and just to set the context, in terms of the marketplace, we expect the bridging market to grow by about 5% this year, on the back of 4.2% last year. We expect that to be a good opportunity for us to continue to contribute growth and to the group. Otherwise, you can see that we're investing, trying to make sure that our profile remains strong in the market, expanding some network distribution and investing in our systems, and also, very importantly, in our people in terms of upskilling them to be able to support the level of growth that we want and the quality of the business that we want. I'll now hand you back over to Anthony.
Thank you very much indeed, all the participants. I'm not going to repeat what I said at the beginning because I want to get on to questions. But I must say that the markets in which we operate and the way that we address those markets are extremely healthy at the moment. And although we have some short-term challenges in terms of regulation in one of our businesses, along with everybody else in the industry, we expect to overcome those in a very constructive way, work closely with the FCA and resume our growth path in profits. So that's the good news so far as our investors are concerned. I've just been looking at some of the questions that have been coming in, as well as ones that have been resubmitted. There are three on gearing and on borrowing. One from Daniel G, one from Javier B, and one from John G. So we've got Daniel G. If you could read that one out first of all.
Yes, from Daniel, we have, when you're assessing a company's leverage, how differently do you view the leverage from Advantage versus the leverage from Aspen? Do you have one common measure of a company's overall leverage or two separate categories in terms of debt capacity and risk?
Chris, would you like to address that one?
Yeah, thank you very much for the question, Daniel. So we try and maintain a bit of flexibility actually in terms of where we allocate group funds, so we don't separate them or view them too differently in terms of where we are actually employing the company's debt, and if there is a better opportunity in one asset area, then we reallocate to that, or we would raise extra funds according to what we wanted to do. So I hope that answers the question.
Good, thank you. And the next one is Javier B.
So are higher provisions in Advantage related to economic environment, or does it have more to do with the FCA regulatory issues?
Yes.
I can take that one if that's all right, Anthony. So these are impairment provisions, which clearly had gone up when we looked at the income statement by 74% this year. The higher provisions in a way relate to both these features because they relate to higher levels of arrears and lower levels of repayments in the second half of the year, as we described. So why do I say it relates to both? Well, the lower levels of repayments relate both to the macroeconomic environment in terms of a few more customers struggling with the cost of living crisis towards the end of the year. But it also can relate to FCA regulatory issues where, as Carl described, we are being quite cautious in terms of our interpretation of the new consumer duty rules, and also where we are in discussions with the regulators on borrowers in financial difficulty. So both those two things have played a part, I think, in the increase in our impairment charge this year.
Good, thank you, Chris. Javier R. He also asked a question about gearing and borrowing. Could you read that one out, please?
So from the outside, it seems like you've increased your leverage at the worst time. Given that returns have come lower than expected, are you still comfortable with your current gearing level?
Well, shall I answer that, and then Chris can come in as you want to. Yes, we are. Otherwise, we wouldn't have gone there. It's well below our current bank funding and longer term funding covenants. We always believe that a business of such as ours is dependent on its collections, and that is a very good measure of its success. And with the exception of maybe recent collections at Advantage, which I've explained to investors, our collections history is very strong indeed and has rebounded slightly earlier this year. So yes, I'm happy with the level of gearing. Obviously, our gearing is only there to support either the investment in the business, and we do that because we see good opportunities, or rewards for our shareholders in terms of dividends, and those are rewards that are well earned and hopefully appreciated and will continue. Chris, do you want to add anything there?
No, I totally agree. We try and look at the gearing and the borrowings level as following the asset opportunity. Now, in this case, as Javier mentioned, returns have come lower than expected. So, yes, we did expect slightly higher returns when we decided to push the level of borrowings and gearings upwards during the year, but we're still comfortable with the current gearing level. And as I said earlier, I think it's relatively low for a finance group.
Thank you. There was a question which was pre-submitted on algorithms and their use in underwriting, which I thought was an interesting question. The trouble is I don't have the name.
Towards the top.
So, yeah.
So this one was from Jay. So it says, given recent advances in AI, do you see algorithms being used to underwrite car loans?
Yes, we already do. Many lenders do, and as I say, it's early days, my time within the business, but it's capabilities that have been built in-house, and are quite deep and extensive. Do use a high degree of automation and what some may term as AI, but anything that serves the customer quicker, widens access, is going to be embraced, and AI is one of those. So there's a number of initiatives, both specifically within Advantage and across the industry, that will make much more of that. But as I say, we are already highly automated from a credit risk perspective already.
I think we would just expand a bit on the return on capital employed query, because obviously that's pretty critical, as you say, when we're increasing our capital investment. We didn't really, we weren't too explicit on that. We are constantly pushing to improve our return on capital employed, impairments and other kind of interventions allowing. And we are conscious, particularly at Aspen, that we're looking for a return on capital employed is certainly well in excess of 10%, and that's actually improving year on year. And in Advantage, that we'd like to return to the return on capital employees of over 20% in the housing days, but unfortunately competition seems to have stopped that. And now we'll be looking for a minimum of 13 and hopefully heading northwards of that.
Excellent. Yeah, I mean, I'm glad we actually addressed that, because I think they were putting on return on equity, but then we've answered the gearing point as well. So I think we've covered that. But thanks, Graham, for that. We also have an interesting question from Dominic C. On forbearance, which I think we ought to address. And that's over to you, Carl, if you want to read that one out.
Does the increase in forbearance mean that you're simply not collecting from some overdue loans where you would previously have negotiated a reduced payment amount, which then impacts on the borrower's credit record? If so, are these loans more likely to fail, hence the increase in provisions?
I mean, there's the short answer to that is no. We're not doing that. But the increase in forbearance is again going back to both time, effort, information, and engagement. So there are a broader list of things that constitute good forbearance, broader opportunities, sometimes over perhaps a slightly longer period of time than previously. And I'm talking as an industry here, not specifically of in regards to Advantage. The clear outcome is to make sure that there's the right outcome for both the lender and the customer in equal measure. So I don't see the negative in anything sort of referred to within that question.
And could we also address Damien's, sorry to call you Dominic, Damien, that's my writing, Damien's other question, which is just below it there.
With the reduction in products that you're willing to sell in the current FCA environment, is this likely to turn into a permanent change, which reduces your addressable market for motor finance?
It does not. I mean, you're quite right, Damien. You would have seen some product sales from other providers. The most recent ban, but yet sort of 1 month extension currently for gap sales, but that impacts both lenders and intermediaries as a good example of the reduction in products. It may well be in other areas the list of closed products is growing. We are is a very large market. We are very good at motivating applications within it. So I don't, and we have a singular product really in hire purchase currently. So I don't think the direction of travel is a further reduction in product. I think quite the opposite in the years ahead.
Just to make it plain, Damien, we didn't actually, or not recently, offer a gap product. We I think used to, but that was I think 10 years ago. Huh?
Yeah, we finished doing that in 2015.
Yeah. So we haven't really reduced our product range in that regard, and we don't intend to. And indeed, we intend to maintain our addressable market for motor finance across the piece. There may well be a small contraction, first of all, for regulatory reasons. We want to make sure that the way that we're dealing with customers who may be seen as more vulnerable is as it should be, and I'm actually certain it is. But nevertheless, we want to demonstrate that to the FCA. But we still want to offer the full suite of products to the full breadth of our customer base in the longer term. So I hope that answers Damien C's question. There's another question that I saw come up on electric vehicles, which I thought was interesting. It was a pre-submitted question, so I don't know who it's from.
Yes, so this one is from Roger, and it says, how will the potential continued reduction in the value of EVs have on the company?
It's a great question. Obviously, a lot of people interested in this space. I think all vehicle values over the multi-year viewpoint can appear quite volatile. Over the more recent times, we've seen more volatility in used car prices for EVs, but that will tend to, as always, bottom out and level out over the longer period. It's going to be a good long time until the used car park becomes EV to a point of being interested and having an impact on any lender with an average age of vehicles sort of 6 or 7 years old at the point of execution. So very, very little is the short answer on that. But I would say also the volatility in pricing will even out over the longer term anyway. So I don't think the volatile price reduction for used EVs will have a negative impact for anybody. We're much less exposed to that because that's not our market currently with where the used car park is today.
Excellent. And can I ask next, go to a pre-submitted question, which is that one, yes, Harry, no, the one about Aspen.
Oh, yes. Given the success of Aspen since its founding in 2017, What are your views on its long-term contribution to the group?
Over to you, Ed.
Well, obviously, from an Aspen perspective, we see a great opportunity to continue to provide to the group a diversified product, an additional stream of business in a market that is expected to grow, in which we currently hold a smaller share of a relatively large market, not compared to the mainstream mortgage market, certainly in the bridging market. And also the bridging market and that type of lending and borrowing is not provided by mainstream lenders. We don't see that changing anytime soon, and therefore we continue to do what we're doing and bringing on quality customers and quality projects. We see a great long-term future contributor to the group.
Yes, yeah. I mean, I would just take the opportunity, I don't know whether my brother wants to say something, but that we're very pleased indeed with the progress that's been made at Aspen since we founded in 2017, and we think it's got great potential. One, we're pleased that obviously the profitability has risen every year. We've obviously injected quite a lot of capital into it, and my brother's already mentioned the return on capital employed, and we want to see that improve, but it will improve as the business grows and economies of scale become more accessible. Secondly, we were very pleased about the amount of business that they're generating and the kind of credibility that they're generating in the broker market, which is mainly broker-led. We're also very pleased, however, that there are more Aspen Direct, as we call it, introductions into the business, which obviously mean that we are getting to repeat customers, and repeat customers only come back to you if you're developing an excellent reputation. And the final thing that I would say we're pleased about is the improvement in efficiency, because we do monitor on a quarterly basis productivity, in other words, deals per member of staff, deals per particular part of the business, the underwriting business, the collections business, and so on. And those are improving all the time. And I think we've really got a very serious business in prospect for Aspen. They're doing very well indeed. Right. I'm trying to see the next one that we ought to be looking at. Keep going. Apologies, everybody. I'm looking at this on the screen. Keep on going. Yeah.
One there about Rocky and return.
Is that the Rocky?
Number 8 might be.
Yes. I think we've already covered that. I mean, are there any new questions that are coming along? Because I don't want to just...
The last one was from John about gearing. So that's one of the...
Yeah, which is one we've already covered, I think. So I think actually we've covered the waterfront. There's no point in just answering questions that haven't been asked. This is meant to be an interactive forum, and that's precisely what we are making it. Can I just say to IMC, very valuable so far as we're concerned, and hopefully valuable so far as your viewers and listeners are concerned.
Perfect. And thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Aspen U PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.